Hey everyone, welcome back to Corporate Decoder, the place where we decode the real story behind the numbers that shape our world. Today we're diving into Multiways Holdings Limited's latest filing, and let me tell you, it's a packed one with some eye-opening details. This document is essentially a prospectus, a kind of announcement for investors about new shares being offered to the public. It tells you what the company is selling and why they need the money. Multiways Holdings Limited trades on the NYSE American Exchange under the ticker MWG. They are offering up to 18 million ordinary shares along with warrants to buy more shares. The price they're aiming for is about 20.5 cents per share, which is a 30% discount from their recent market price of 29 cents. Each share comes bundled with a warrant. Now, the company identifies itself as an emerging growth company and a foreign private issuer. This basically means they can follow some less strict reporting rules compared to larger US companies. They are allowed to give less financial history and have some flexibility with certain accounting standards. This offering is being done on a best efforts basis. This is a really important point. It means the company is trying its best to sell these shares, but there's no guarantee they'll sell a minimum amount to make their business plans happen. Investors might not get their money back if the offering falls short. Let's jump to the financials. For the year ending December 2024, their total revenue was about $31.1 million. That's a drop of almost 14% compared to the previous year when they brought in $36 million. This decrease was mainly due to lower demand for their equipment sales and services, though their rental income did help cushion the blow a bit. Following that revenue drop, they also saw their net loss increase from about $1.8 million in 2023 to a $2.9 million loss in 2024. This increase in loss seems to be driven by things like inventory write-downs and share-based compensation expenses. However, looking at their gross profit, it actually went up slightly from $8.7 million in 2023 to $9.7 million in 2024. This sounds good on the surface, but their overall gross profit margin also improved significantly from 24% to over 31%. This suggests a shift in their sales mix towards higher margin items, which is a positive sign despite the revenue dip. When we look at their balance sheet, their accounts receivable, the money customers owe them, increased from $5.3 million in 2023 to $6.2 million in 2024. This isn't necessarily bad, but it means they need to be diligent in collecting payments. Their inventories also grew substantially from $36.7 million in 2023 to over $45 million in 2024. This could indicate they're stocking up in anticipation of future sales or perhaps facing slower sales than expected for some items. Now let's talk about the risks. The company faces significant risks tied to the cyclical nature of the industries they serve, like construction, mining, and oil and gas. When these industries slow down, so does the demand for their equipment and services. They're also exposed to risks from political and economic changes in the countries where they operate or plan to expand. This means they have to navigate a complex web of global factors that are beyond their direct control. A major point here is their controlling shareholder, Mr. Eng Hock Lim, through MW Investments, holds a majority of the company's shares. This means he has significant power over corporate decisions, which might not always align with what other shareholders want. They also warn this concentrated control could limit your ability to influence changes or push for mergers. On a more positive note, they highlight their long and strong relationships with both suppliers and customers, which is a solid foundation for business. They mentioned that their top 5 customers accounted for about 33% of sales in 2024 and about 36% in 2024 and about 36% in 2023, showing a dependence on key clients. They also point to their experienced management team led by their CEO, Mr. Eng Hock Lim, who has over 30 years of experience in the heavy construction equipment industry. This leadership is presented as a key strength. The company's roots go back to 1988 with Mr. Lim starting the business. The current holding company structure, Multiways Holdings Limited, was actually incorporated in 2022, but the operating subsidiary in Singapore has been around since 2002. They have 2 equity incentive plans, the 2023 and 2024 plans, designed to reward employees and directors with company shares. As of late 2024, they had issued quite a few shares under these plans, including to key executives like Mr. Eng Hock Lim and Ms. Noi Gek Lee. Digging a bit deeper into their revenue breakdown for equipment sales in 2024 that brought in $21.5 million, about 40% came from Singapore and the rest from overseas. This shows a reliance on international markets for their sales. The story of Multiways Holdings is really the story of founder Ang Hock Lim. He's been in this business for decades, building the company from a small proprietorship to its current listed status. His long experience is presented as a cornerstone of the company's stability. Looking at their geographic revenue, sales in Australia saw a significant drop of about $6 million in 2024 compared to 2023. Also, revenue from other countries decreased by $4.2 million, a clear sign of softening global demand. They mention having 14 employees certified to operate cranes in Singapore, a detail highlighting their operational compliance and skilled workforce in a regulated environment. A key competitive strength they tout is their long track record and industry experience, especially in Singapore, which they believe builds trust and loyalty with customers. Their business strategy includes further expanding and renewing their equipment fleet, increasing storage facilities, and potentially pursuing acquisitions or joint ventures. They also aim to use technology to boost efficiency in their labor-intensive operations. A significant risk factor they highlight is that there's no public market for the warrants being offered, meaning their liquidity will be very limited. Interestingly, while 2024 showed a loss, 2023 actually saw a profit of $1.8 million, an increase from $1 million in 2022. This profit was largely due to a gain on the disposal of property and equipment. They state they believe they have enough working capital for the next 12 months, but this is contingent on no unforeseen circumstances and relies on cash on hand and operational cash flows, which, as we saw, were negative in 2024. Their total liabilities jumped significantly from $36.2 million in 2023 to almost $50 million in 2024. This increase is concerning and needs to be watched closely, especially given their current financial losses. The controlling shareholder MW Investments holds a substantial 61.8% of the company's shares. Even after the offering, if all shares are sold, they would still control over 40%. This concentration of power is a key factor for any potential investor to consider. So what's the story here? Multiways Holdings is a seasoned player in the heavy equipment market with a strong operational base in Singapore and a history spanning decades, built on the leadership of its founder. They have a skilled workforce and good supplier relationships. However, the company is facing headwinds. Revenue declined in 2024, leading to a wider net loss, while their debt and inventory levels increased. The reliance on a controlling shareholder and the best efforts nature of this offering also present significant risks. While they've shown profitability in prior years, current trends suggest a challenging period ahead, and investors should be very aware of the risks involved, particularly the lack of a secondary market for the warrants and the company's dependence on market cycles. What's your take on Multiways Holdings Limited? Do their strategies and experienced leadership outweigh the current financial pressures and market risks? Let us know your thoughts in the comments below. If you found this breakdown useful, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth analyses of company filings. And hey, don't forget to join our Discord community linked in the description to continue the conversation and connect with other financially savvy folks. Thanks for watching, and we'll catch you in the next Decode.